Hello there, and welcome to Virtual Nexus and Crypto Diaries. Today we're going to talk about minding the money. I've done this presentation 3 times today. Hopefully you'll benefit from the number of revisions I've had to make. Originally, I'd done a bunch of trades on a browser wallet with a hardware wallet, some swaps I talked about later too. But I realized with the current banking crunch and credit crises and things like this, people need to know where money comes from. So let me give you a little background here. Before I continue, cryptocurrencies and blockchain investments are extremely speculative and risky. They fall outside much of current regulatory frameworks and as such are risky for novice, inexperienced, and experienced investors. Because of its novel nature, the cryptocurrency market is fraught with many difficult to evaluate assets, including fraud, scams, and schemes. Do not risk anything you cannot stand to lose. Furthermore, intensive due diligence surrounding complex technical, financial, and regulatory issues is required in this market. This presentation, all associated with crypto diaries and virtual nexus, are for educational purposes only. We never recommend the purchase, sale, nor trading of any specific asset or issue. However, we do offer information to enable our audience to learn how to manage their own risk and potentially capitalize on mispricing in the cryptocurrency and blockchain market. So what spawned this discussion was we had a failure of Silvergate Bank. They went into bankruptcy. Silicon Valley Bank, which was bought, and Signature Bank, which was solvent. So the banks have been closing what they used to call on-ramps to crypto, but I call it off-ramps to Federal Reserve fiat money. And so what caused these things? So we're going to talk about the money supply, where money comes from, money velocity, how fast it changes hands, what fractional reserve banking is. I talk about wholesale finance, but we're going to skip that, and we're going to do the credit crunch, freeze, and liquidity shortage. So what you're looking at here is a graph of the money supply. You can see it rise precipitously. This graph is through 2008, but it does in 2020, it goes even higher. So the money supply is measured in M0, which is currency in circulation and actual money in the bank, in the vault. That's the monetary base. M1 includes M0 plus demand deposits and traveler checks. That means deposits that you can demand and traveler's checks, which are already out. And then M2 equals M1 plus savings accounts less than 100K. M3 includes time deposits like CDs, so you can get a 3-month certificate of deposit where you deposit the money, and the bank gives you a paid amount of interest over a specific period of time. So where does this money come from? So before we get there, we'll talk about money velocity. That's how rapidly money changes hands in an economy. It's a measure of economic activity, okay? And it's a ratio of GDP, the gross domestic product, over the money supply. And as you'll see, our velocity has fallen precipitously since 2008 as the amount of money in circulation has grown massively through either A, quantitative easing, cutting interest rates and keeping the money interest rate too low, 0 for too long, and then basically the COVID stimulus payments and a variety of other balance expanding techniques, okay? So money velocity is a measure of speed, how quickly it can change hands, efficiency, how efficient the market is, how much it costs, right, to send money back and forth, and the volume, just the sheer amount of transactions. All right, so fractional reserve banking. There you go. So people used to think money was backed by gold. It is not. That's hard asset or asset-backed money. We talked about Islamic finance in number 6, part 6 of this series of blockchain fundamentals. And that is a hard asset, usually a 1-to-1 ratio. We're going to talk about algorithmic coins in the future, which is kind of what fiat is. Originally, it had all gold backed. Then it had partially backed by different types of assets. Then it had partially backed, and now it's not backed at all, okay, by any type of hard asset. The way fractional reserve banking works, say Alice puts $100 in the bank. The bank must keep the reserve requirement of 10%. It loans out $90. In theory, that $90 is deposited back in the banking system, and 90% of that, or $81, is loaned out again. Okay, so at any given time, there is a tiny amount of reserves in there for the bank to give people their money. But those deposits are used to make loans, and that's how velocity is increased of money. That's how you increase the transactions in our economy. Credit is one of the number one reasons why the Western world has grown so rapidly in the last 500 years. Okay, and so this is the argument. There's an argument on the Bankless podcast series for the last week or so, and you had Balaji Srinivasan saying Bitcoin's going to hit 1 million because the banks are insolvent. They're not insolvent. Okay, then you had Arthur Hayes saying that there's the interest rate risk between how much they bought a bunch of bonds that are worth less. So they do not have enough money to pay reserves. So what the central bank did, said we will extend deposits to protect depositors so that we do not have a bank run. That is insurance. The bank run is when everybody asks for their money back that's not there. During the Depression, they actually closed banks down, and a lot of the bank robbers and the violence was due to the banks foreclosing on people's property, which we talked about in Islamic finance a little bit. Okay, I'm not Muslim, but I do respect and honor the spiritual traditions of the world and the laws that they have come up with, okay, which we'll talk about some other time. So, money supply, it comes from basically fractional reserve finance. There's more money out there, which increases velocity, which causes your economy to grow faster. The risk, though, is when confidence falls. So you don't want to make people afraid for the economy, but you do want to be sure to kind of protect people. That's the trade-off. Okay, so Ben Hunt said that this was irresponsible and that there's no way this was a temporary option, but there was the zero interest rates, which was temporary in 2008, stayed down for over 10 years. Okay, so about 10 years. So that's a big deal. All right, now, a credit freeze or liquidity crisis is there's no loans, so velocity slows. No one makes loans. They have what's called the repo market, and that's where banks generally loan overnight. During 2008, that froze up, and then it became a liquidity crisis. Nobody had the money, okay? And right now, they have different types of liquidity issues because the assets on the bank's books, those treasury bills, are worth less than they bought them at. Okay, there's shortage of cash flow, right? Because velocity is slowed down, so there's not a lot of money, to pay things. And then leverage, there's an increase in the cost of borrowing, financing, and increase in margin requirements. That's the risk, okay? In the first one, a credit freeze, no loans are made. In the second, there's no way to make payments. And so the credit crunch means there's no ability to get loans to build, economy halts. Liquidity crisis might include when foreign countries have no dollars, a shortage. So we talked about, you may have heard of not Nicaragua, but El Salvador. They're basically a Bitcoinized, meaning that they're dollarized already. They have their own currency. They don't trade. And then they added Bitcoin because there's not enough dollars out there to pay debts in dollars. There's a shortage of dollars worldwide because it's a reserve currency. So a lot of banks and countries and central banks are switching out of dollars, which is going to lower the value of dollars. And those dollars are going to come home, which is going to reduce the value of dollars. This is the big fear out there. Now, Balaji said it's going to happen in 90 days. Arthur Sayes said a couple of years. And then we had Ben Hunt said, yes, it's also going to reprice. But James Bianchi on Bankless said that it's going to take some time, and he is correct. Because what happened is people are taking their money out of the banks and putting them into money market funds. And so those banks don't have the money. So the BTFP, that's the bank window opened up so that banks can borrow money at 5% to cover deposits, which is extremely expensive for a bank right now. So, summary. The money supply comes from basically fractional reserve banking, money velocities, how fast it changes hands. Fractional reserves put you at risk. Okay, you've got a credit and liquidity crisis. So credit repo market in 2008 led to a liquidity crisis. What does this mean for crypto? Why is Mr. Karate telling you this? He's telling you this because there's hard assets like gold, which is being tokenized. Bitcoin is considered a hard asset. I'm not going to come down on whether it is or not, but I will tell you gold is. And they have tokenized gold out there. Okay, and that I think is going to be a good asset. It's not good. I shouldn't say good. That asset class has a long history, thousands of years. 3 areas they do not turn in their gold. The Greeks, the Indians, and the Chinese. What do they have in common? They're ancient civilizations. Finally, I want to talk about Frax, or a fractional stablecoin. That is the future of finance, in my opinion. That is a partially asset-backed currency, right? So Frax has some hard assets right now, uses USDC and maybe some other tokens in there, but eventually just imagine if a fractional reserve stablecoin had gold, tokenized gold in there. Think about that. And the reserve rate algorithmically change. This is a rules-based currency. And what I'm reading and what I'm seeing, that's the future of both crypto and finance. Listen, God bless you all. Thank you for coming here, for minding the money. And we'll return to much more crypto-focused things as the blockchain fundamentals continues.